What's up guys, so today we're going to talk about moving average, and hopefully by the end of this very short course you can get an idea on what are some of the ways that you can use your moving average. Okay, so before I get to the first point, remember to trade at your own risk. Some of the things that you need to take note of when it comes to moving average. Okay, the first thing first is please don't just use moving average alone to enter. You need a lot more indicators because after all, your moving average is a lagging indicator. It is not a leading indicator. It is lagging behind price. And also you need to understand one thing, okay? If you are trading short time frames, it's better to use shorter parameters like smaller numbers. And if you are using higher time frames, then it's better for you to use larger moving averages like 100, 200. Use the right numbers for the right kind of time frame. So you need to learn how to read false signals. Now the first function of moving average is that you can use it as a support resistance to be specific. Dynamic support resistance. So for example, if you throw a basketball to the ceiling, it's going to bounce back down. If you throw a basketball down to the floor, it's going to bounce back up. So you just pretend that your moving average is like a floor and a ceiling. And then you treat your price as your basketball. Okay, so come up and touch moving average, it bounces off, sometimes it crosses it. You need to understand what's the difference between a temporary market correction with a permanent reversal, because sometimes markets can break the ceiling and then come back down, and sometimes it'll go up, bounce on the ceiling, in this case it's the ceiling, okay, and then immediately it'll bounce back down, okay. And it does that a couple of times before the trend ends. So when price pull back to moving average, you need to use additional confirmation indicators to tell that, okay, I can sell here. Alright? Don't just rely on price retracing back to moving average alone and then you'll be like, okay, I'm gonna sell. You need confirmation indicators. Please remember that. Now if you're a complete beginner, just understand that don't trade against the trend, and when price is below moving average, it is a sell market. You don't want to buy during a downtrend because as a beginner, it increases your risk of getting stopped up. So why not just go with the flow? Only when you're more experienced, you can trade reversals. But for now, if you're a beginner, please follow the trend. The second function of moving average, I think I said to you just now. How do you know whether you're trading in a bullish and bearish market? You use a large number moving average, like for example this line over here that I use from just now. Okay, this is your 100 moving average. If I can just write down, because I know people ask me. 100 SMA. Okay, this is your 100 SMA. So when the price crosses moving average and moves higher, further and further away from the moving average, it tells you that, okay, this is a bullish trend. But the problem is moving average doesn't tell you how long the trend will last. Okay, doesn't tell how long the trend would last. It'll give you a clue as to when the bullish trend will stop, but please don't just rely on that. Okay, because you know why? A lot of people say that, okay, when the price goes below moving average, then this is time to sell. Don't just rely on this, because sometimes market can pierce downwards and then go in a range just like this. You know what I'm saying? Add more confirmation indicators that gives you clues and signals that market is going to reverse for sure. It's not just here to trick you. It's not a temporary market correction, but it is a real reversal. Okay, now there are many ways that you can determine when a trend will end. One of the ways is use trend lines. When price break a very strong trend line, then goes below moving average, it gives you a confirmation that, okay, bullish trend is ending. The bulls are losing. The bears are starting to come in. Now one tip you need to understand when it comes to moving average is the slope. Like what I said just now, the slope is very important. The angle is very important. So for example, if I'm to draw a horizontal line over here and measure from 0 right to here, can you guess what's the angle? Look at this right now. Okay, look at this. About 60 degrees from the horizontal level. What does 60 degrees tell you? Does it mean anything? Now you already know that, or maybe you don't know that. If the moving average is going sideways, it tells you that the trend is not strong, or the market is ranging, it's going sideways. the trend is undecided. The larger the angle, the stronger is the trend, and hence you can say that this upward trend, even though it's pretty smooth sailing, but it's not as strong. And the other function of moving average, it may cross over. It's like two strings, you tie a knot, it cross each other. So let's say for example, I have here your 50 SMA in red color, and then I have here your usual white color, that is your 100 SMA from just now. If you were paying attention, ladies and gentlemen, so when the two moving average intersect, cross each other, this gives you a confirmation, okay, not guaranteed, but a confirmation that a price might move bearish or bullish. So if you see 100 SMA being above 50 SMA, normally you see a downward bearish trend, okay. And then if you see 50 SMA being above 100 SMA, you see a long-term bullish trend. Of course, in the short term, you see false signals, crossovers like here, okay. So to put it simply, if the larger SMA is above the smaller SMA, then it is a bearish market. If the smaller SMA is above the larger SMA, then it is a bullish market. Actually, I should write it fully. Then a lot of people say, Karen, crossovers don't work. Because if you see this crossover, alright, and you just rely on one time frame, you just rely on H1 to look for signals, then you might get stopped out over here thinking that bearish trend is coming. You know what I'm saying? And this is why some people say crossovers don't work. Because if you look at this false crossover over here, okay, and this false crossover, and I put a vertical line here and here, and I shift to another time frame, which is H4 time frame. Why did this not go bullish? Why did this false crossover not go bearish? Is because if I switch to H4, you see at this point of time, candlesticks are still in a bearish trend. At this point of time, your candlesticks are in a bullish trend. You don't see price over here going below moving average, right? Instead, it bounced off this moving average in the higher time frame. Same thing for this bearish trend over here. Candlestick bounced off moving average in the H4 time frame. Alright, please check the higher time frames, especially if you are trading long term. Bear in mind that I don't scalp, so if you want scalping tips, how to scalp with this, I cannot give you advice, okay? Okay, so then let me know down in the comment section below which is your favorite strategy, which is your favorite function. Okay, so with that, I'll talk to you in the next video. Bye.